Yes, so we can begin our class. So in our previous class, in this case, we had looked at accounting for long-term construction contracts. And I think we were able to look at two illustrations. I gave an assignment, which I haven't seen anyone having to share, whether they have been able to attempt. So hopefully you attempted, hopefully you attempted. So we need to move on. We need to move on because time is not on our side. So we're going to start looking at what we call borrowing costs. Still under topic number 2, you write borrowing costs. Borrowing costs. You write borrowing costs. This one is according to International Accounting Standard number 23. It is IAS number 23. So IAS number 23. So you write borrowing costs accounted for under International Accounting Standard number 23. Accounting Standard number 23. So before we write something and look at an illustration regarding how you account for what we call borrowing costs, so I'll be able to explain something here. I'll be able to explain something here. So of course, you know what it means to borrow. This one I don't have to define for you. You are very good students of English from standard 1. You know what it means in this case to do what? To borrow. So in this case, when in this case you get a resource in the form of money from another party. And of course, you'll be under obligation to pay what we call a principal amount and what we call what? An interest. An interest, what we call a principal amount and what we call what in this case what? An interest. Maybe you'll pay with an interest, but not always. So when you borrow from your friend, he might call upon you to maybe pay back with interest, or in this case, you might just pay the amount you borrowed. So within companies or reporting entities, still they end up having to borrow. They can be able to borrow, for example, to finance projects. Maybe they want to do construction of maybe a building, construction of maybe in this case a warehouse, construction of maybe in this case a storage facility. They don't have the funds. So in this case, a reporting entity or a company, like a company, would end up having to borrow or get the financing maybe from a bank or any other source. So when in this case they borrow the funds, for example, in this case to end up having to put up maybe those capital projects or come up with those capital projects, they likely end up having to repay back the amount. So of course now in this case it's not for free. So when the bank ends up having to lend this reporting entity, it is not in this case actually for free. So they, like in this case costs, you can see now, they'll be like in this case what? Costs that will be incurred when you borrow. There'll be in this case what? Costs that will likely end up having to be incurred when you borrow. For example, in this case, you'll likely be forced to pay back with what you call what? Interest. So that interest becomes part of what? The cost that you've been able to incur as a result of having to borrow. Another cost could be, it could be as a result of, in this case, what? Maybe you incurred legal fees. Legal fees. So to enter into this kind of a borrowing agreement or contract, you, in this case, sourced for the services of a lawyer for consultancy to, in this case, maybe draft an agreement for you. So you incurred a legal fee. Sometimes if you end up having to borrow from, for example, in this case, a foreign market, your borrowing will likely, in this case, be affected by fluctuation in foreign exchange rates. For example, if you can be able to recall very well, when this government came into office, so they were having to say that they're having to repay back what? The Eurobond. With what? A lot of money. So in this case, when the Eurobond was actually, for example, in this case, acquired, maybe that Eurobond, that is like a money that was borrowed from Europe or from the Western countries. It was in this case in what? In euros. Or in this case, it could have actually been in dollars. Let's assume it was in dollars. So when the government actually came into office, there was a high fluctuation in this case in terms of what? The dollar. I think the dollar went up in this case 150 shillings. If you can be able to recall very well. There's a time it went up to 160 shillings. So it means, so for each and every dollar we had actually borrowed, if we had actually borrowed a dollar when it was in this case at 120, we were paying 40 shillings extra. We were paying back 40 shillings extra because of what? A fluctuation in what? Foreign exchange rates. So these ones end up having, for example, in this case now costs, what we call what? The costs of borrowing ending up having to rise. So there'll be this cost that in this case will likely be incurred whenever in this case a reporting entity has borrowed money. So when they borrow this money, they likely in this case, for example, put into what we call capital projects. And in this case, they put into capital projects. This standard provides us with the guidance as to how you account for such kind of borrowing costs whenever in this case such kind of a borrowing is actually utilized for capital projects within what a reporting entity. Ideally, what is supposed to happen is that when you're having to account for this kind of, for example, a capital project, let's say in this case, for example, they borrowed maybe 20 million. They borrowed 20 million. When they borrowed this 20 million, because you're having to say they borrowed what a cost. Part of the cost in this case, which is most obviously and predominant, it is what? Interest. So they are borrowed, they want in this case to construct a building worth. So this building requires an amount of 20 million. This amount has actually been borrowed. It has been borrowed, but it will be repaid back. It will be repaid back with an interest of 10%. With an interest of 10%. Interest of 10% per annum. So per annum. Interest of 10% in this case, what? Per annum. 10% per annum. Of course, they'll be able to give you like the period of repayment. They will give you the period of what? Repayment. So what this standard provides is how do we account for these borrowing costs whenever this amount, for example, in this case, is utilized in having to come up with what capital projects, such as a building. Remember, this building, you've already actually been advised by your contractor that in this case, the cost will likely end up having to be 20 million. It will be 20 million to come up with this building, but you don't have the money. You've gone in this case to do what? To borrow. You've actually been able to borrow from the bank. They have given you the money, but now they're having to tell you that in this case, we'll charge you 10% interest per annum. Interest per annum. So it means by the end of the first year, you would have actually been able to incur how much interest? 2 million, because 10% of this is actually what? 2 million. Is actually 2 million. So what this standard actually requires, whenever you're having to account for this kind of borrowing costs, if this amount that is actually borrowed is put into a capital project, like having to come up with a building, then the borrowing costs, these are very important points that I'm just having to mention with that arrow. The borrowing cost should actually be capitalized. The borrowing cost should actually be done or to be capitalized. And which kind of borrowing costs? The borrowing costs that in this case were incurred during the active period. During the active, this statement I'm writing here is very important. During the active period of construction. Construction. So the question you should actually be asking yourself, when Mwalimu says capitalize, what does he mean? We simply basically mean that in this case, the borrowing cost incurred over the active period of construction should be included as part of what? The value or the cost of the asset. They should actually in this case be included as what? As part of the cost of the asset. That's what the standard requires. So in this case, they borrowed 20 million at 10% per annum. It means in this case, by the end of the year, they would have actually been able to incur how much? 2 million. 2 million as in this case of the interest. But now, let's assume in this case, this amount was actually borrowed on 1st of January, 2025. So this construction of the building is actually going to take, in this case, how many months? 4 months. It's going to take 4 months. So it means in this case, this interest over this period of active construction should actually in this case be part and parcel of the cost of the building. So when in this case, we'll likely be reporting the value of this building in our books of accounts at the end of this 2025, it will not in this case be what? Be 20 million. It will be ideally in this case, 20 million plus the capitalization of the borrowing cost during the active period of construction. Active period of construction is how many months? 4 months. We'll be able to say 4 out of 12. Multiplied by that, what? Interest, which in this case is what? It is 2 million. Don't ask me where 2 million is having to come from. This is simple mathematics. 10% of this per annum is exactly 2 million. So now it is only for 4 months. You are portioned for 4 months. So in this case, 4 but 12, like that. You'll be able to get the math there, the mathematics there. It is a third, or it is a third. So you'll be able to come to this case, what? 20.667. I think 20.667 something. Because if you take a third of this, third of that is how much? 0.66. Yes, something like that. 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 We are in topic number 2. We are in topic number 2. So something like that. So it means in this case, what you'll be able to report as the cost of the building in the statement of financial position at the end of 2025 will be this amount. It will not be 20 million, the original cost that was supposed to be incurred. The borrowing costs that were incurred to borrow this amount for construction will also be capitalized or be put as part of the cost of, in this case, what? The asset. As part of the cost of the asset. Now, in this case, the question would be, what about the rest of the interest? The rest of the interest will likely be recognized as an expense in the income statement. As you capitalize for the 4 months, the remaining interest from the end of the 4th month, moving forward, whether in this case it is 2 years, 3 years, 4 years, that one, now in this case, will be accounted for in the income statement as what? As an interest expense or a finance cost. Or a finance what? Cost. Or a finance cost. That's why in this case, it's likely to what it will be accounted for. Sometimes you might actually, in this case, borrow this amount, 20 million, but you don't need it what? Immediately. You don't need it immediately. So of course, you've been able to incur, in this case, what? During the active period of construction, you've actually been able to incur 0.667, because this is the interest you're having to incur. If you do the math, during the active period, you've incurred how much interest? 0.667, which you are saying you are supposed to capitalize and include it as part of the cost of the asset. When you report at the end of the financial year, you won't just report 20 million. What should be appearing in your statement of financial position should be the cost of that building plus the borrowing cost, but in this case, during what? The active period of construction. But in this case, wewe ni Mkenya, wewe ni Mkenya, wewe ni Mkenya. You know Kenyans, how they behave. You know Kenyans, how they behave. How do Kenyans behave? You might get this 20 million from the bank, but in this case, you don't need it immediately. You don't need the entire of this amount immediately. Maybe in this case, for the first 2 months, you need how much? 10 million immediately. But the remaining 10 million, you won't actually need it immediately. So you are a clever Kenyan. You know how Kenyans behave. So you might take this 10 million and put in a fixed deposit account. Fixed deposit account for 2 months to be able to gain. Now you are gaining what? Interest. You know how Kenyans behave. So you can, this is what you need. So you commence the project on fast. You know you need to inject in 10 million immediately. Your contractor tells you need 10 million. You need to give me 10 million for me to be able to commence this project. The other 10 million will give me after 2 months. So you are a Kenyan. So you know how Kenyans behave. You take this 10 million, you put in this case in what? In a fixed deposit account. When you put in this fixed deposit account, you earn interest. Now you're not having to pay interest here. You earn interest on the 10 million. So this interest you earn, you can be able to set it off from this amount. So remember, in this case, the interest, the borrowing cost for the 4 months is how much? 0.667. But tumesema nini? You wewe ni Mkenya. You are a Kenyan in this case. Kenyans are very clever. You will take this 10 million, he'll put in a fixed deposit account. In that fixed deposit account, he's maybe having to earn, in this case, what? Interest at 2% per month. So you'll calculate 2% of this 10 million. I think you'll get 20,000 or something. So you'll be able to earn, in this case, what? 20,000 per month. For the 2 months, it will be 40,000. It will be 40,000. So it means in this case, you'll have to set it off on this what? Borrowing cost. So we'll be able to say the cost of this building will likely be 20 million plus the borrowing cost during the active period of construction, which is 0.667. But now we are having to say you need to set off the interest you've earned, and this interest you've earned, mark you, it should be during only what? The period of what? Active construction. If you earned the interest for maybe a number of months, you need to ignore all those other months. Only consider that interest you earned during the active period of what? Of construction. So in this case, you're having to say it was what? 40,000 like that. So that is in this case what? Minus 0.04. So that in this case now, you'll be able to get the total cost of this asset to be able to report in the statement of financial position. Of essence here, what you're having to drive home is that reporting entities sometimes incur what we call what? Borrowing costs. If these borrowing costs have actually arisen as a result of a borrowing that was actually utilized for a capital project, the borrowing cost ideally should actually be included as part of the cost of the asset at the end of the financial year. But which kind of borrowing cost? Is only the borrowing cost that in this case was actually incurred This statement is important. Active period of construction of what? The capital project. Active period of what? The capital project. Sometimes in this case, if the amount is invested, and in this case now the reporting entity gains interest, that interest earned should be set off from, in this case, what? The borrowing cost. With that now, in this case, you can be able to get what? The final or the net figure, in this case, what? For the amount to be capitalized in the statement of what? Financial position. Financial what? In this case, position. And therefore, you can be able to write this about borrowing costs. Once I've been able to explain that, now we can be able to write this about what? Borrowing cost. Write this about borrowing cost. Write this about borrowing cost. So start with the definition. So try to define in this case what? Borrowing cost. So definition. You can be able to write this about borrowing costs. These are costs associated with what? Borrowing. They are costs. They are costs associated with borrowing. They are costs associated with borrowing. E.g., I can give examples. E.g., interest, legal fees, foreign exchange fluctuation losses, foreign exchange fluctuation losses, flotation costs. This, for example, when you are issuing something we call a debenture. When you are issuing something we call a debenture. A debenture is like an instrument the company can be able to sell to raise money. So this one you learn more about it in your company law. So your company law lecturer will teach you this one, debentures. So you normally issue something we call a prospectus, then you'll incur some cost there. So you'll be taught by your company law lecturer about that. So flotation cost can also in this case do what be incurred, but majorly what we'll be able to focus on is the interest under this particular standard. But you can also be able to have flotation cost as part of the cost you can be able to incur when you're having to, in this case, do what? Borrow. When you're ending up having to, in this case, do what? Borrow. Ending up having to borrow. Those are just, in this case, what? The examples. Then you can be able to write the next statement after definition of what is a borrowing cost. What is a borrowing cost? After being able to write that, you can be able to write another statement. Borrowing cost incurred, borrowing costs incurred, borrowing costs incurred as a result of a borrowing to be utilized for construction of qualifying assets. Borrowing costs incurred, you can be able to underline borrowing costs. You can underline borrowing costs. Then also you can be able to underline qualifying assets. The borrowing cost incurred as a result of borrowing, a borrowing to be utilized for construction of a qualifying asset are to be capitalized as part of the cost of the assets. That's what I'm just trying to, in this case, explain there. So there's a new term having to come here, that qualifying assets. So that those assets that in this case qualify for us to be able to say the borrowing cost incurred for the amount borrowed to construct such kind of assets is one that in this case can actually do what? Be capitalized. So what is a qualifying asset? So in this case, you could be asking yourself, what is a qualifying asset? Which kind of assets will be able to qualify for us to be able to say when they were constructed as a result of an amount borrowed, then the borrowing cost incurred on that amount should be included as part of the cost of the asset. So there's a new term having to come here what is a qualifying asset? What is a qualifying asset? So you can be able to write a qualifying asset. Qualifying assets. A qualifying asset is an asset. A qualifying asset. A qualifying asset is an asset. Is an asset. What is a qualifying asset? A qualifying asset is an asset that takes a substantial period of time. That takes a substantial period of time. That takes a substantial. That takes a substantial period of time. That takes a substantial period of time. Period of time. That takes a substantial period of time. Period of time to get it ready for the intended use. To get it ready for the intended use. To get it ready. To get it ready for the intended use. To get it ready for the intended use. So you can be able to give examples. You can be able to give examples. So you write examples, e.g. What are some of examples of, in this case, of qualifying assets? You can be able to give examples, e.g. manufacturing plants, manufacturing plants, manufacturing plants, manufacturing plants, manufacturing plants, power generation facilities, power generation facilities, power generation facilities, buildings, storage facilities, buildings, storage facilities, so storage facilities, investment properties, So buildings for the purpose of having to rent, for example. So you can go say investment properties. So those are, in this case, just but the examples of, in this case, of some of the qualifying assets. That in this case, when you're having to construct this kind of assets from an amount that is borrowed, then you have to consider to do what? To capitalize. To capitalize, in this case, what? The borrowing costs. You have to, in this case, capitalize the borrowing costs. To capitalize the borrowing cost. So that's what, in this case, we'll be able to have there. So now, in this case, we want to know how you'll be able to account for the borrowing costs. So accounting treatment of the borrowing costs. How do you account for them? Accounting treatment of the borrowing costs. So you can be able to write another small heading. Accounting treatment for the borrowing costs. Accounting treatment for the borrowing costs. Another small heading, accounting treatment for the borrowing costs. So now in this case, when you are preparing your books of accounts, so how do you account for these borrowing costs? Accounting treatment for the borrowing costs. Accounting treatment for the borrowing costs. So accounting treatment for the borrowing costs. Accounting treatment for the borrowing costs. So you can be able to write number one. Number one, you can be able to write. Number one. So interest in card, the interest in card, during the active period of construction, during the active period of construction, interest incurred during the active period of construction will be capitalized as part of the cost of the asset, as part of the cost of the qualifying asset, as part of the cost of the qualifying asset, Then number two, Interest incurred during the inactive. Interest incurred during the inactive. During the inactive. Inactive. During the inactive. Inactive. During the inactive. So you can be able to align this. Here it is active, but this is now during what? The inactive. During the inactive period of construction is when you're not constructing. During the inactive, during the inactive, you can underline inactive. So take note, we are saying inactive. Zipporah, we are saying inactive when you're not having to construct. Interest incurred during the inactive period of construction. Period of construction will be recognized as finance cost, or interest will be recognized as finance cost or interest in the income statement. In the income statement or in the P&L account or the P&L account. So that's when you don't actually end up having to include it as part of the cost of the asset. So in this case, what? Just calculate it, but now you'll be able to report it in what? In your income statement as what? As finance cost, or what in this case we call what? Interest. Or what we call in this case what? Interest. Or what in this case we call what? Interest. And repairs cost be capitalized. Repairs cost be capitalized. So they cannot be capitalized. Those ones, those are repairs and maintenance. So they can be taken as what? Maybe we can go say administrative cost or something. But take note, we are not talking about repairs here. Our focus is what? Borrowing costs. So our focus is borrowing costs. So but repairs, they cannot be capitalized. They can't be capitalized. So you can be able to write the next point, number three. You can be able to write number three. Interest income and from temporary investments of the unutilized funds should be deducted from the borrowing costs during the active period of construction, during the active period of construction, So that's what I was having to say. You are a Kenyan, so you know how Kenyans behave. They can invest some of this money. For example, in this case, if it is not needed immediately, they can invest some of this money if it is not needed immediately. So that's how Kenyans behave, so that they can be able to earn more money. When they earn more money, because they are very clever, then in this case, they'll be able to set off the borrowing cost. And of course, that will be able to reduce what? The cost of the asset. It will reduce the cost of the asset. So of course, you'll be able to see when you do what? An illustration. You'll be able to see when you do in this case what? An illustration. Then another very important point. Sometimes you can do the borrowing, but now in this case, you are financed by two financial institutions. Like that 20 million of ours, you'll be financed by two banks. So you'll be financed by Equity and also likely be financed by Commonwealth. So Equity has their own, in this case, what? Interest rates on the amount borrowed. Because in this case, you are focusing on what? On the interest. So Equity, they have their own interest on the 10 million. Commonwealth, they also have their own interest on the 10 million, the other 10 million. So in total, it is 20. So if that is the case, then in this case, you have to calculate what we call what? A capitalization interest rate. You have to calculate what we call a capitalization interest rate. That in this case, you'll be able to use to calculate what amount you'll be able to capitalize. Because in this case, you realize Equity, they are giving you at an interest rate of 15%. Commonwealth, they are giving you, this is the 10 million. And in this case, Bank, they are going to give in this case at an interest of maybe in this case 12% on the loan of the 10 million. So in total, you've been able to get to 20 million. So how will you account? Because now in this case, you have two interest rates here. How will you account for the borrowing cost? And now in this case, what? The $1 million question. That is the $1 million question. That is the $1 million question. That is the $1 million question. How will you be able to account for the two? In this case, you don't have to start shivering and wondering, what am I going to do? For example, if you see this one in the exam, so what you'll be able to do, we are going to say you'll be able to calculate what we call what? A capitalization. Capitalization. You'll calculate what we call a capitalization interest rate. Interest rate. So how do you calculate it? You take the aggregate. You'll be able to aggregate. In this case, take the aggregate interest payable. You divide by the aggregate amount borrowed. You, in this case, take the aggregate. To aggregate is to add. In this case, to aggregate in this case is to add. In this case, it is to add. So what you'll do here, Ezra, you don't have to start wondering what will I be able to do. You'll come up with what we call what? A capitalization interest rate. So this interest rate, you'll in this case end up just having to take the aggregate interest payable. You'll take the aggregate interest payable, you divide by the aggregate amount borrowed. Aggregate amount borrowed. Aggregate amount borrowed, you multiply by what? 100%. 100%. For example, in this case, actually, in our situation here, what you'll be able to do, we are saying aggregate the interest payable. So in this case, you'll take 15%, multiplied by the 10 million from Equity Bank ya Mwananchi, from Equity Bank ya Mwananchi. You multiply by, in this case, what? These are the bank. I don't know why it is called cooperative. Is it for the cooperative societies? I don't know. I can't tell. But in this case, you'll be able to add. You'll be able to aggregate it. It is to add. So you'll take 12%, multiply by 10 million. 10 million. Then you divide by the aggregate amount borrowed. We really have to do that one. It is 20M. In this case, 10 plus 10. How simple is this? With that, you need to multiply with 100%. You should be able to get an aggregate rate there, or what we call now in this case of capitalization interest rate. With this rate now, you can actually now be able to calculate. You can now in this case be able to calculate what is the interest to be capitalized on that asset. So you'll be able to get a single interest rate that you can be able to use to calculate what? The borrowing cost to be, in this case, included with the 20 million to be put in the statement of what? Financial position. So you can be able to write point number 4. You can be able to write. When a qualifying asset is financed, hope you are writing. Number 4, when a qualifying asset is financed by more than one debt instrument, or you can also say when a qualifying asset is financed by more than one amount borrowed. When a qualifying asset is financed by more than one amount borrowed, stroke debt instrument, by more than one amount borrowed stroke debt instrument. So there can be different instruments having to finance the asset. So when a qualifying asset is financed by more than one amount borrowed stroke, stroke simply means all. Don't write stroke in your book. Even if someone was written stroke, don't write strokes. You put basically like this, then you say debt instrument, comma. The capitalization interest rate will be calculated. The capitalization interest rate will be calculated as follows. The capitalization interest rate will be calculated as follows. Then in this case, you say semicolon. You put a semicolon after as follows. You need to make your notes to be more organized. They should be more organized than even those ones of what home. You need to put a semicolon. Semi, do we put a full or semi? I don't know, but you can put semi. So semicolon like that. Then you say, will be calculated as follows. Then in this case, you say, you put a formula, you say capitalization interest rate, you say capitalization interest rate, you say capitalization interest rate is equals to aggregate interest payable. Are you seeing the board? You should look on the board. So now you can be able to look at the board. Look at the board, Ezra. You now put this formula, capitalization interest rate is equals to aggregate. I've just been able to write an abbreviation there. At least write in full. So don't write the way I've written here, because now in this case you'll be looking at your notes and wondering what is ag. What is ag? You're now revising. It is 2 minutes to the exam. Before you get into the exam room, you want to get the formula and you're saying ag. Then in this case, you go to the exam room having to say ag interest rate, but now you even don't know what is ag. So you need to write in full aggregate interest payable over aggregate amount borrowed, multiply by 100%. Multiply by 100%. Multiply by 100%. So aggregate interest payable over aggregate amount borrowed, multiply by 100%. 100%. So like that. 100% like that. Because now in this case, you would have the formula there where you have. We're going to look at an illustration where we have such kind of a scenario. We have such kind of, in this case, what? A scenario. Such kind of, in this case, what? A scenario. Then the very final statement, before now in this case, we go to the mathematics of the things. We go to the mathematics of it. You need to write the final statement, which in this case is number 5. Before we go to now the real thing. The real thing. So these are a lot of stories of saying what and what. We want the mathematics part of it for us to be able to see by ourselves. We need to see by ourselves. How do we do these mathematics? So in this case, you can be able to write number 5, which is the final statement. Then we can be able to look at an illustration. So say interest in card, or and number 5, interest in card, or and interest in card or and during the pre-construction period. Interest in card during the pre-construction period should not be considered as part of the borrowing cost, as part of the borrowing cost, to be capitalized, as part of the borrowing cost to be capitalized. In short, what you're having to say, you must have already been able to understand capitalized. My friend, you must have already been able to understand when I say capitalized. They shouldn't actually be included as part of the cost of the asset. Shouldn't actually be included as part of the cost of the asset. In short, what you're having to say, that in this case, you might have, in this case, borrowed the amount on New Year's Eve, let's say around January start. So, like that, 1st of January 2025, year of wonders. This is the year of wonders. Year of what? Wonders. You borrow the amount here, 20 million. Remember, that is the amount you are having to borrow. But now, in this case, in January, you can't get the contractors. Bado wako sherehe ya mwaka mpya, bado wako sherehe mazi. So new year, people are celebrating. So after the 2nd week, 3rd week is when now they start coming back to work like that. They're on leave. So January, you might in this case just be having that money. It is just there. Maybe you can invest. So they'll be able to start on 1st of February. Month of, in this case, what? Month of love, February there. February, they'll be able to start in February. So this one, it means when you borrow the money here, the money was just idle. This is now the pre-construction period. So in this case, still you'll be able to incur a borrowing cost here, because the bank will end up having to still charge you interest even in January. Not that in this case you are not using the funds, the bank will say, oh, relax, because you've not started, we won't charge you that one. The bank is also in business, so they will still charge you here. So this interest here, you won't consider it. So because you started here, maybe you might start here, you do up to, in this case, what, maybe June. So maybe it could be June, or maybe in this case, it can actually be, in this case, be what, be May, 31st of May. 2025. So for the next what? Is it 3 months? So it will be February, March, April, May. So 4 months. These are 4 months. So 4 months you've actually been constructing. So but the first month here, it was pre. It was actually in this case what pre. So you won't consider this interest here. You'll only be able to consider the interest here in the 4 month here as part of what the borrowing cost. But this one you won't consider. Even if in this case you invested the money here, if you invested the money up in this case, maybe the month of June, or maybe the month of maybe March, the month of March, end of March. So it means in this case, there are 2 months here. 2 months here. The interest earned here, you won't consider it. You have to deduct it when you're calculating what the borrowing cost to be capitalized. Because you've been able to say, you need to take in this case the interest incurred during the active period of construction, that is the 4 months. You deduct the interest earned. So the interest earned was for 2 months here. This is the only one you'll be able to consider when you're calculating in this case what the borrowing cost. Now, of course, you're going to see when you're going to do what? A question. In this case, let's not in this case just do a lot of talking here. So this a lot of talking sometimes is not good. It's not even enjoyable. Let's just do an illustration. So let's not talk a lot here. Why are we talking a lot? Why are we talking a lot? We need to do an illustration. You can be able to write an illustration now. In this case, we are going to do an illustration December 2022. December 2022. You can open it. So I told you in this case now, the past paper should be like your dictionary. They should be like your dictionary. You should just be having them because you can see now in this case, I'm referencing a past paper in December 2022. Do you have it? Do you have it? So December 2022, question number 3B. December 2022, question number 3B. Once you are there, you say, we have it, I have it. Don't say we, but say, I have it. I have it. Once you are there, you say, I have it. So that in this case, you can be able to start looking at that particular illustration. You say, I have it. You can be able to say, I have it. I have it. Do you have it? Admin, do you have it? Ali, do you have it? Ezekiel, do you have it? Daniel, do you have it? Mercy says, people are having it. People are having it. Anne says, I have it. So at least another 2 or 3 should be able to confirm so that we can be able to know we are on the same page. We can be able to know whether we are on the same page. I can be able to see. Ashley says, I have it. People are alert. People are alert. People are alert. Nyini wale wase. Nyini wale wase. Nyini wale wase. Nyini wale wase. So we can be able to look at it. So it says, Sayari Limited obtained 10% loan note amounting to 24 million on 1st of January 2021 to finance the construction of a new factory. As the funds were not all required immediately, Sayari Limited invested 10 million in 6% bonds until 31st of May 2021. Construction of the factory began on 1st of March 2021. However, due to an unexpected shortage of skilled labor, the project ceased during the month of July and August. By 31st of December 2021, the project was not in this case not complete. So by the end of the year, they were still having to construct it. So it was a long-term project as well. So required. Explain with suitable calculations the accounting treatment of interest on costs on the loan notes in the financial statements of Sayari Limited for the year ended 31st of December 2021 in accordance with the International Accounting Standard number 23, in this case, what? Borrowing costs. Borrowing costs. So it is of so much importance here that you try in this case to identify active periods and inactive periods, because you can be able to see that's where the meat of the concept is. That's where the meat of the concept in borrowing cost is active periods and inactive periods. That's where the meat of the concept in borrowing cost is actually is in this case found in this case under what the calculations here. So if you look at in this case what you've actually been given there, let's in this case assume we don't start having to confuse ourselves with a lot of mathematics, but you have to be very keen. Ezra, you must be very keen. Let's assume in this case you have our year there. You've actually been told that in this case they borrowed how much? 24 million. It was 24 million. When 10% on 1st of January. It was on 1st of January 2024. 2024. That is what happened to finance what? Construction of a new factory. Then, as the funds were not all required immediately, Sayari Limited invested shillings 10 million in 6% bonds. So immediately here, They invested up to 31st of, so up to 31st of, in this case, what? 31st of May, they actually invested. So there was a what? An investment. Investment for how many months? 5 months. 5 months. For investment for, in this case, what? 5 months. How much did they actually end up having to invest? So they invested 10 million. So this investment here was actually 10 million. It was 10 million. It was 10 million. It was 10 million. It was 10 million. When you continue the statement, it's having to say, as the funds were not all required immediately, Salary Limited invested 10 million in 6% bonds until 31st of May. That was for 5 months. Construction of the factory began on 1st of March. So the construction began somewhere here. Actually, it began somewhere here. 1st of March. 1st of March. 1st of March in this case is when they began, in this case, what the construction. Is when they began what the construction. Then you are told, however, due to unexpected shortage of skilled labor, the project ceased during the month of July and August. So there's somewhere in this case in between here. So July and August. July and August. The month of July and in this case what? August. There was nothing having to happen. There was in this case what? Inactiveness. There was in this case what? Inactiveness. So if in this case, you look here, this is what? The pre-construction period. So the pre-construction period here is how many months? Pre-construction period is how many months? The pre-construction period is how many months? Also try to think. So let me not think for you everything. The pre-construction period is how many months? Try to juggle your mind a bit. It is 2 months. Exactly in this case what? The pre-construction period is actually in this case how many months? 2 months. Exactly in this case how many months? 2 months. So because they actually began here. They began here on what? 1st of March, 2025. But now in this case, they didn't actually do any construction here. July and August, there was in this case what? Inactiveness. So then you are told, due to unexpected shortage of skilled labor, the project ceased during the month of July and August 2021. By 31st of December 2021, the project was not complete. So in this case, by this data, the project was having to still in this case do what? Ongoing on. It was still in this case going on. It is actually 2021. It's not 2024, but it's 2021. It is 2021. Sorry about that. It is 2020. 21. I don't know why I'm thinking about 2024. 2024 must have been a nice year for me. That's why I'm having to still remember it. Must have been a very nice year for me. Must have been a really nice year for me. Why I'm just remembering 2021. So who can be able to tell me? Tell me. So now in this case, also juggle your mind. The active. How many months? The active period of construction is how many months? Who can be able to tell me? Also juggle your mind. Just juggle your mind and try to look at what I've indicated there. The active period of construction up to the end of the year is how many months? It is how many months? It is how many months? James says 4. The active period of construction up to the end of the year is how many months? It is supposed to be 8. It is supposed to be 8. It is supposed to be 8 because you see, here there was no construction. It was the pre-construction period, which was 2 months. Then they constructed. They constructed up to, in this case, what? Up to, in this case, end of June. Up to end of June. So in this case, we have March, April, May, June. They constructed. Then July and August, there was nothing happening. So initially here, before this period here of July and August, the 4-month year, there was a lot happening. So this 4 months, there was activeness in terms of what? Construction. But July and August, there was inactivity. But now September, October, November, December, they constructed 4 months. So the period of active construction in this case is how many months? 4 plus 4, which in this case ends up having to be how many months? 8. So it means when in this case you're having to consider the borrowing cost. The borrowing cost on the amount borrowed, will only be able to consider for how many months? 8 months. For 8 months, which means in this case you have to consider 8 months out of 12, multiplied by the amount borrowed, multiplied by in this case what's the interest rate. So this particular number line here or debt line here can be able to help you in this case. So for example, identify where was activeness, where was inactiveness, which was the pre-construction period, over which particular period, in this case, the amount was actually, in this case, done what? Maybe invested. So also I can be able to ask you, so in this case, I can be able to know whether you're having to grasp the concept you're having to learn here or not. We're having to say that this amount borrowed was invested on 1st of January, it was 10 million, up to 31st of May. It was for 5 months. It was for 5 months. And being able to say the interest that in this case is earned is supposed to be set off from the borrowing cost. From the borrowing, in this case, what cost? So interest for how many months should we be able to set off? Who can be able to tell us? Interest for how many months should we end up having to set off? Also juggle your mind. Juggle your mind. Juggle your mind. Interest for how many months should we be able to set off from the borrowing cost? Juggle your mind. Juggle your mind. Remember, the amount was actually in this case done what? Invested here for 5 months. The building started to be constructed on 1st of March 2021. So which interest should we end up having to set off? It is for 3 months. It is for 3 months because they invested for 5 months, but now they started constructing here. Interest was earned for 3 months here until, in this case, the end of what? The investment. When the project was having to do what? It was ongoing on. So take note that in this case, the interest we set off is only the interest earned during the active period of construction, which in this case is exactly what? Exactly in this case what? March, April, May. But for January and February, we won't consider it because we started constructing here. So of course, the borrowing cost will be for 8 months. But now the interest earned over the 3 months during the period of active construction, we have to set it off from the borrowing cost during what? The active period of what? Construction. That's what in this case you have to take note of. So the interest that in this case will be able to set off from the borrowing cost is for the 3 months when the building was having to be constructed. That interest earned when the building was not having to be constructed, don't consider it to be set off under what? The borrowing cost. Under the borrowing cost. So once you've been able to grasp this, then things about borrowing cost is actually very easy. You can now, in this case, be able to come up with what? Your calculation. But I hope you've been able to write this number line because it can be able to help you just to be able to, in this case, do what? Break it down. Before now, in this case, you start what? The mathematics part of it. The mathematics part of it. So in this case, we can now be able to do the mathematics once you've been able to understand the pre-construction, the active construction, the interest earned during the active period, and in this case, what? The pre-construction, and in this case, what? The period of dormancy. The period of dormancy. So in this case, you can be able to say the net interest to be capitalized, 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 the net interest to be capitalized will be for the active period of construction, will be for the active period of construction, i.e. 8 months, i.e. 8 months, i.e. 8 months. So this is how you can be able to just calculate it. So you can be able to say, total interest costs for the year. You can be able to say our shillings are actually in this case in millions. You can be able to put our shillings in millions or in thousands. Let's put in thousands like that. Put in thousands like that. You can put in thousands like that. So and we will say total interest cost for the year. Total interest cost for the year. Interest costs for the year. Total interest cost for the year. So because you can be able to do the mathematics there, it is actually 10%. It is 10%. 10% multiplied by 24 million. So you'll be able to get 2.4 million. You'll get 2.4 million. You'll get 2.4 million. So this is the total for the entire. But now we have what? The pre-construction period. So less interest, less interest, less interest, interest during the pre-construction period, interest incurred, less interest incurred during pre-construction, So it is not supposed to be part of, in this case, what? So the pre-construction period was in this case 2 months. Left, we'll be able to say 2 out of 12 multiplied by 10% multiplied by 24 million. So what do you get? 2 out of 12 multiplied by 10%, because the reconstruction period as per our deadline, it is 2 months. We need to deduct it from the interest for the entire year. So it is 2 out of 12 multiplied by 10% multiplied by 24. What do you get? You'll be able to get a figure there. You'll get a figure there. 2 out of 12 multiplied by 24 million multiplied by 10. You get 400. So in this case, you have to less it because it is not supposed to be part of the borrowing cost. Then also there was a dormancy period. So less interest incurred during the inactive period. During the inactive period. It was also 2 months. Inactive period was also 2 months during the inactive period. And then we go to say 2 out of 12 multiplied by 10% multiplied by 24 million. So this one, it is still 400. So in this case, it's actually 400. 400. It will actually in this case be what before 100. It will actually in this case be what before 400, like that. So you've been able to write. Hope 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 you've been able to write. So it is 400. Then you can lessen and continue. Continue just down there. So you know me, I can't continue because you can't see there. So don't go beside what you're doing. You just continue. Just continue. So just continue. Me, I'm doing this because you can't see down there. So in this case, I still have your shillings in thousands. So what are we going to less again? So you can be able to less interest and on investments during active period of construction. During active period of construction, which you've been able to say it was 3 months. It was 3 months. And therefore you'll be able to take 3 out of 12. 3 out of 12 multiplied by the amount invested, which was in this case 10 million. How much interest was being earned? You need to look at how much interest was being earned of this money. So they were earning in this case, they invested in what? 6%. Are they 6% debentures or something? 6% bonds. So they were earning interest of 6%. So you multiply by 6%. Multiply by 6%. You need to deduct because in this case it will less the borrowing cost. It will less the borrowing cost. You need to deduct. What do you get? 6% of 10 million multiplied by 3 out of 12. You get it is 3 out of 12 multiplied by 10 million multiplied by 6%. What do you get? You get 250. Confirm your figure. Confirm your figure there. 6% multiplied by 10 million multiplied by 3 out of 12. It is 150. 150. So you need to be very keen. It is 150. Remember, in this case, it is during the active period of construction. As per that deadline, of course, the interest was earned for 5 months. But take note is important. I'm having to say what? Underline this. Underline this. Active period of construction. Have you underlined that, Zipporah? Have you underlined that, Zipporah? You need to underline that. You need to underline that. So in this case, you'll be able to deduct in this case what? 150. So what do you get in this case as the borrowing costs? What do you get as the borrowing cost? What do you get as the borrowing cost? What do you get as the borrowing cost? Now in this case, 400 minus 400 minus 400 minus 150. You get 1450. So the borrowing cost in this case is actually 1450. It's actually 1450. In this case, what? 1450. So then you can be able to write. The borrowing cost will be capitalized. The borrowing cost will be capitalized and included as part of the cost of the asset. the borrowing cost will be capitalized and included as part of the cost of the asset. The borrowing cost will be capitalized and included as part of the cost of the asset. The borrowing cost will be capitalized and included as part of the cost of the asset by the end of the financial year. By the end of the financial year, and included as part of the cost of the asset by the end of the financial year. 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 Then the next point you can be able to write. The pre-construction interest, the pre-construction interest and interest incurred during the dormancy period. The pre-construction interest incurred, and the interest incurred during the dormancy period, will be accounted for as finance cost, or interest expense will be accounted for as finance cost or interest expense by the end of the financial year, or interest expense by the end of the financial year, or interest expense by the end of the financial year, by the end of the financial year, by the end of the financial year, by the end of the financial year. So the pre-construction interest incurred, and the interest during the dormancy period, will be accounted for as finance cost, or interest expense, in the income statement, by the end of the financial year, or interest expense by the end of the financial year. So finance cost and interest expense is the same. It means the same thing. They are costs incurred to finance your operations of a business. So in this case, part of it is like what we call interest. So there's another question which I want us to look at. Let me see whether I can be able to get this question for you so that we can have a break. Then when you come back, I want us to look at it very fast. So let me see whether I can be able to share with you here, because I'm suspecting you don't have it in your past papers bunch. You don't have it in your past papers bunch. So the interest earned before, it will likely be accounted for as interest income. So that will will likely be interest income. You'll account for it as interest income in your books of accounts. So it will be interest income. It won't actually be set off on the asset borrowing cost, but it will likely be interest income. I don't know whether you've been able to get that past paper. I've been able to share there. Download it. You can be able to download it, because I know you might not actually be having it in your set of past papers. So Vivian, that one will be interest income. It will be interest income because you've not been able to set it off on the borrowing cost, so it will likely be accounted for as interest income. So it will be interest income, so like that. So I've been able to share a past paper there on your charter. So we can take a break. Let's have a break. We can stretch. We can have a water break. Yes, so welcome back. So I think we can proceed. So there's that past paper question I've shared there. Have you been able to get it? Have you been able to get it? Have you been able to get it? September 2021. I can see my friend is asking there, where is the question? User is asking, where is the question? So it is in that past paper. You go to question number, there's a question there. There's a question there. You go to question number 4A. So if you are there, you can say yes. So September 2021, question number 4A. September 2021, question number 4A. So September 2021, question number 4A. So I can see you are saying yes, that you are there. So let me get it. Let me get it here, just a minute. Yeah, so the question is there. So for the benefit of those who might, so you're told Darubini Limited has provided the following schedule of its long-term loans for the year ended 31st of December 2020. So you are told in this case, on 1st of January, up to the end of the year, they had 3 loans. We had a 10% loan note, we had 12% bond, we had 6% debentures. So those loans are for a period of, there's one for 5 years, another one for 8 years, another one for 4 years. Then you are told, how did they utilize this amount of money? You are told the 10% loan note and 12% bonds were used to finance the construction of a power plant, which commenced on 1st of January 2020. Expenditure for the construction was drawn, with 100 million being drawn on 1st of January and 75 million being drawn on 1st of July 2020. The number 2, the 6% debenture was used to finance the construction of a new storage facility. The construction commenced on 1st of January 2020, but no construction took place between 1st of March 2020 to 31st of May 2020 due to COVID-19 restrictions. The facility was available for use on 31st of December 2020, having incurred a construction cost of, in this case, how much? 60 million. Then, in line with the provisions of International Accounting Standard number 23, borrowing cost, determine the borrowing cost to be capitalized on each of the projects as at 31st of December 2020, the value of the assets in the books of accounts by the end of December 2020. So, of course, in this case, there are like 2 projects they're having to undertake. There's one for the power plant, and there's another one in this case for a storage facility. So this one for the power plant is as per note number 1. As per note number 1. So as per note number 1, we'll have to determine what? As per note number 1, what will we have to determine if you're having to look at the borrowing cost of this power plant? What are we going to determine for us to be able to know the borrowing cost of this power plant? Who can be able to tell us? Try to juggle your mind. So, Vivian, try to think by yourself. You are in the exam now. You are alone. The teacher is not there. The teacher is not there. You are in the exam alone now. Vivian, you have to at least try to juggle your mind left, right, and center. So we'll come up with what? The capitalization interest rate. Wow. Wow. This is very brilliant. This is very brilliant. That is correct, because now in this case, this asset will be financed by what? 2 loans. It will be financed by 2 loans, as you can be able to see. And then in this case, you have to do what? Calculate what we call the capitalization interest rate. The capitalization interest rate. So that in this case, you can be able to know how much of the borrowing cost will actually be incurred on having to construct, in this case, what the power plant. Of course, for the other one, the storage facility, that one has no issue. It has no problem. So it's a single loan. So that is very easy. You just be able to directly calculate the borrowing cost during the active period of what? Construction. So in this case, if you're talking about, in this case, coming up with the capitalization interest rate, we had already said that in this case, if an asset is financed by two loans, so like in this case, what? The storage facility. Like in this case, what? The power plant, sorry. So the power plant, power plant financed by two loans, financed by two borrowings, financed by two borrowings. Therefore, compute the capitalization interest rate, the capitalization interest rate. And how do you get this one? So of course, you must always be able to remember the formula. If you want these things to stick, you have to always first of all state the formula. In this case, be able to say the aggregate interest payable, the aggregate interest payable, we divide by the aggregate amount borrowed, the aggregate amount borrowed, we multiply by 100%. We multiply by 100%. So for each and every loan from the two, we'll be able to get how much was in this case what? The interest. How much was in this case what? The interest. So of course for the first loan, the interest rate is actually 10%. It's a 10% loan note. So the amount borrowed was 300,000. The 300,000. So our figures are in what? Our figures are in, let's confirm our figures are in, are they in millions or what are they in? So they're actually in this case in thousands. Our figures are actually in thousands. So the first amount was 300 amount borrowed, and the second one was 200. That is the amount borrowed. This one is 10% interest. This one is 12% interest. And therefore we have to get what? The aggregate interest rate. And therefore in this case, it will actually be 10% of the 300,000. So we do this calculation, it will actually be 10% multiplied by the 300,000. We add on 12% multiplied by that other amount borrowed, was in this case 200,000. So our figures are in thousands. So like that, then we divide by 500,000. The aggregate amount borrowed is 500,000 because if you add the two, 300 plus 200, you get 500. Then you multiply by 100%. What you get as the capitalization interest rate? Do the mathematics. Now do the mathematics. What you get as the capitalization interest rate? Do the mathematics there. You'll get 10.8%. So you get 10.8%. So 10.8%. So it is very easy like that. So with this now capitalization interest rate, we can now be able to calculate what? The borrowing cost. You can be able to calculate the borrowing cost. The borrowing cost, you can calculate the borrowing cost very easily. You can easily be able to calculate the borrowing cost. So you can come up with the borrowing cost. So we've already been able to write. I'm wrapping here so that I can be able to write properly, so that you can be able to see. So now the borrowing cost, therefore the borrowing cost, borrowing costs on storage facility. The borrowing cost on storage facility. The borrowing cost on the storage facility will likely be, in this case, there were two amounts that were utilized. There were two amounts that were utilized on, in this case of the storage. It's not storage, but power plant, sorry. The first one is actually power plant. The borrowing cost on the power plant. On the first one is power plant. On the power plant, there were two amounts utilized. There was 100,000, and there was in this case what? 75,000. So 75,000 or 75 million and 100 million. So in this case, for the power plant, in this case, we'll have on 100 million. So you'll be able to calculate the borrowing cost there. We've been able to get 10.8%, 10.8% multiplied by 100,000. You should be able to get our borrowing cost there. Then on the 75 million, you still use the same rate. It will be 10.8% multiplied by 75,000. So for this one, you'll be able to get 100 108 or 10,800. So is it be 10,800? So our shillings are in thousands. So like that. Then 10.8% of 75. What do you get? 10.8% of 75. You can do the calculation. 10.8% of 75. There's something you'll be able to get there. 10.8% is equal to 10.8% multiplied by 75,000. Because there were two amounts utilized on the power plant. There was 100, and then later on they used in this case what? 75. It was 75. You'll get 80. Then there's something you have to take note of. It was from which month? So it was from which month? It was from which month? Let's confirm there. It was from which month? Let's confirm there. So you are told that the 10% loan notes and 12% bonds were used to finance the construction of the power plant, which commenced on 1st of January. The expenditure for the construction was drawn with 100 million being drawn immediately. So this one was for the entire year. But now this one was actually drawn on 1st of July. So it means it was for how many months? 6 months. So it was in this case for 6 months. It was for 6 months. And then we have to consider that period. So you'll be able to say multiply by 6 out of 12. 6 over 12. So with that, then now you need to get the difference. You'll get 40. The difference you'll be able to get what? 40 what? 40, 50. You'll get 40, 50 because now in this case the amount was for 6 months. In this case, you get 40, 50. 40, 50. And therefore the borrowing cost, it will be 14,800. And if this is a borrowing cost, in this case on the power plant. That is the borrowing cost on the power plant. So that's why you end up having to get it. You add the two. Then you can go to the borrowing cost. Then in this case, you can go to the storage facility. The storage facility in this case doesn't have a lot of issues. Only that in this case, you'll be told that there was a period of dormancy. There was a period of dormancy. There was a period of inactiveness, where in this case, the construction never took place. So for the storage facility now, therefore, for the storage facility, borrowing cost, for the storage facility borrowing cost. So the borrowing cost for the storage facility, you'll be able to consider how many months as active period. For the storage facility, how many months are we going to consider as active period? Ezekiel, for the storage facility, how many months are we going to consider as the period of activeness? I can see Millicent says 9. Zipporah says 9. Ashley says 9. Yes, it is true. It is 9. It is 9. Wow, 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 wow. That is very fantastic. 9 out of 12 multiplied by the amount that was in this case utilized here was an amount of 60. And they were having to incur an interest of, in this case, how much? 6%. So by 60,000 multiplied by 6%. So what do you get as the borrowing cost? What do you get as the borrowing cost? Ezra, do the mathematics. What do you get as the borrowing cost? You'll get 2,700. That is correct. 2,700. So like that. 2,700 like that. That is in this case what correct. So they wanted you in this case to get the borrowing cost. Then the second part of the question wanted you to show the value of the assets. Wanted you in this case to do what? To show the value of the assets by the end of the financial year. So the value of the assets by the end of the borrowing cost to be capitalized. That's what we've already been able to calculate. And the value of the asset in the books of Darubini Limited as of 31st of December 2020. So we can now in this case get the value of the asset by simply having to take the costs of the items during the year, then we add on the borrowing cost incurred. So number 2, they want you in this case to get what the value of the assets. The value of the assets. So the value of the assets. And get the value of the assets. So number 2, we are supposed to get the value of the assets. The value of the assets. The value of the assets. So because you have in this case the power plant. Then in this case you have the storage facility. The storage facility. So our figures are in shillings of thousands. Our figures are in shillings of thousands, so like that. Shillings of thousands. So amounts invested in this project. So amounts invested in this project. For this one, it was 175. If you add the two amounts, it is 175. For this other one, it is 60. It is 60 million. But now they incurred what? The borrowing costs. Been able to get some borrowing costs they incurred during the year. So for this one, it was having to come to 14,850. And for this one, it was having to come to how much have we gotten? 2,700. Right? So you need to add the two. You need to add the two. So this one will be able to get 189,850. 189,850. This one will be able to get 62,900. So like that. So 6,700 like that. And that basically in this case will likely be in this case be the value of the assets in the statement of financial position by the end of the so value of assets. Value of assets in statement of financial position at the end of the year. At the end of the year. So you have to capitalize. This is what you haven't to you capitalize. You put it as part of the cost of the assets. You put it as part of the cost of the assets, so like that. So that's part of the cost of the assets, like that. So we've been able to complete that one. Have you completed? Confirm whether we are through with that one. Confirm whether you are through with that one. Confirm whether you are through with that one. Are you through? Are you through? Are you through, Ezra? Are you through? James. James is not talking today. I don't know whether James is through. I see Ashley says yes. We are through. Winnie says yes. At least we are through. We are through. We are through. Take your time. Take your time. Take your time. Take your time. Slow but sure. 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 Take your time. Take your time. Slow but sure. Slow but sure. Slow but sure. Yes. If it is slow but sure, but not that through, and be able to run. And be able to wrap. And be able to wrap. And be able to wrap. Now, I want us now in this case, I introduce another area, still under topic number 2. I want you to use another area still under topic number 2. So, still under topic number 2, I want to introduce another area. We call it in this case what? Accounting for hire purchase transactions, right? Is accounting for hire purchase transactions. For hire purchase transactions, accounting, hire purchase transactions, accounting, hire purchase transactions. So you write like that, accounting for hire purchase transactions. Accounting for hire purchase transactions. For hire purchase transactions. So just before in this case we jot or write something down, at least we must be able to understand who is this animal we are calling hire purchase. Who is this animal we are calling hire purchase? What happens under hire purchase transactions? So suppose those who have done law and governance, or law and ethics, I think it is in law and ethics. I think it was removed from law and governance. It is under law and ethics. So those who are doing ATD, they must have come across hire purchase contract. So a hire purchase contract or transaction is a kind of an agreement where we have two parties. So we have the owner of the goods, and we have the hirer. There are two parties under this kind of a transaction. We have the owner of the goods, and we have in this case what? The hirer. So take note, we don't have the seller. We don't have in this case what? The seller. But eventually in this case, the owner can become what? A seller. Eventually, maybe you can actually end up having to what? To be a seller. Because what normally happens under hire purchase transactions or contractor, this owner conveys the right of use in this case what? Of goods. The right of use in this case what? Goods. Whereby the consideration would be that this hirer is able to pay in this case what? An initial deposit. An initial, like in this case what? Deposit. Then he'll be able to pay what? Installment payments. What we call installment payments. Installment payments. So part of the agreement would be that in this case, fully once the installment payments have actually been settled, then the hirer can now fully be able to become what? The owner of the goods. But ideally, under a hire purchase transaction or contractor, the owner basically still ends up having to be the one who has the title of ownership until the final installment or payment has actually been done by the hirer. So it means at some particular point in time, if it happens, this hirer, maybe things have gone marambas for him, he doesn't have the cash to pay. The economy is not having to do so well. So it means that in this case, having to struggle, he cannot be able to settle what? The installments. Part of the agreement in this case under the hire purchase contract could be that this owner can be able to do what we call a repossession of the goods. So you can end up having to repossess them back, and now in this case have the right of, in this case, what? Possession. So the possession basically is having to be enjoyed by, in this case, what? The hirer. When the transaction is actually what? In place, when the contract is actually in place. But if it happens that this hirer defaults on payment, for example, of the installment, part of the agreement could be that this owner can be able to repossess back the goods, can actually end up having to repossess back, in this case, what? The goods. And therefore, what is going to happen, or in this case, the takeaway point that you'll be able to get once you complete learning about accounting for hire purchase transactions, you should be able to understand, for example, in the books of the owner, how will, in this case, this owner be able to account for hire purchase transactions? Maybe in this case, he's having to sell part of his goods in cash, part of his goods in what? In hire purchase transactions or maybe contracts. So how will he be able to account for example, hire purchase transactions that are having to occur what? In the business? That is the takeaway point that you should be able to get. For example, if he does repossessions, how does he deal with it? For example, once this hire purchase transaction has actually been able to occur, how will he be able to recognize the hirers in his books of accounts? How does he recognize the hirers in his books of what? Of accounts? That's the takeaway point that you should be able to get once we complete having to learn about what? Hire purchase transactions. That should be the takeaway home point. But in this case, if you have someone having to deal with hire purchase transactions, maybe also he has cash transactions. He sells on cash basis. Sometimes he ends up having to sell on hire purchase basis. These hire purchase transactions, how can he be able to considerably be able to account for them in his books, or in this case, what? Accounts. And there we'll be able to see part of the accounts that in this case are supposed to be maintained by this owner when he's having to be involved in what we call what? Hire purchase transactions. Hire purchase transactions. That in this case should be the takeaway home point. The objective they should be able to learn once in this case we complete having to learn about what? Hire purchase transactions. And then in this case, let's write something down. Let's write something down so that in this case you can just be able to have a brief understanding before in this case we go into what? The mathematics part of it. Because that's why in this case you really like. That's where I know you really like the mathematics part of it before we go there. That's where I know you really like. You can go to write something small. You write definition, right? Definition. Right, definition. Right, definition. You write definition. It is a contract involving two parties. It is a contract involving two parties. It is a contract involving two parties, i.e., the owner and the hirer. It is a contract involving two parties, i.e., the owner and the hirer. The owner and the hirer. Actually, check here. The owner and the hirer. So, for the hirer, you write like this. The owner and the hirer, like that. It is a contract involving two parties, i.e., the owner and the hirer. Full stop. The owner and the hirer. Full stop. The owner allows the hirer to take possession. The owner allows the hirer to take possession of goods. The owner allows the hirer to take possession of the goods. The owner allows the hirer to take possession of the goods. The owner allows the hirer to take possession of the goods and settle through a consideration of, 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 and settle through a consideration of a deposit a deposit, and installment amount, a deposit and installment amount, a deposit and installment amount over an agreed period of time. A deposit and installment amount over an agreed period of time. An installment amount over an agreed period of time. Over an agreed period of time. Over an agreed period of time. Then you write this. Something here you can be able to write a small formula, you can go write and say higher purchase price is equals to deposit plus higher purchase price is equals to deposit plus installment amount. Higher purchase price is equals to deposit plus all the installment payments. So the higher purchase price is equals to deposit plus all the installment payments. Or you can be able to say, or alternatively, you can be able to say, this is how the higher purchase price normally is determined. Higher purchase price is equals to cash price plus interest. Cash price plus, in this case, what? Interest. So what you'll be able to realize that the higher purchase price is always higher than the cash price. It will always be higher than the cash price because when you buy on cash basis, you pay immediately. But now when you buy on higher purchase, it's like you've been lent money, and therefore there will be some kind of like an interest there. You might realize the cash price is 100,000. But now the seller is having to tell you, if you buy on cash basis, 100. If you buy on higher purchase basis, 120,000. It's like you've been able to see these people who sell what land. Sometimes they could end up having to tell you, if you pay the entire cash immediately, it is 800,000. If you want to buy and put a deposit, then in this case now, you'll like to be paying installment, slowly, dogo. They'll tell you now, in this case, the price is what, 950. So it's like they have charged an interest. Because it's like they have given you the leeway. You are having to hold their money for a long period of time, and therefore they charge you interest over the cash price. Or in this case, you can just be able to take the deposit that you've been able to agree with the owner of the goods. You add on all the installment payments that you'll be able to make over a particular period of time. You should be able to give you what? The higher purchase price. Should be able to give you the higher purchase price. So you can go to write another small heading, methods of accounting for higher purchase transactions. So a small heading, methods of accounting for higher purchase transactions. A small heading, methods of accounting for higher purchase transactions. So you write a small heading, methods of accounting for higher purchase transactions. Methods of accounting for higher purchase transactions. Methods of accounting for higher purchase transactions. So that methods of accounting for higher purchase transactions. Then you write, there are two methods of accounting. There are two methods of accounting. There are two methods of accounting, i.e. There are two methods of accounting, i.e. There are two methods of accounting, i.e. Number one, the interest method. Interest method. Number one is the interest method. Then you write this. Under this method, you write this. So under this one, you can put a semicolon. You write under this method, the interest method, under this method, comma, sales are recognized at cash price. Sales are recognized at cash price, full stop. Under this method, sales are recognized at cash price, full stop. Interest is computed separately Interest is computed separately. Interest is computed separately and considered as an income. Interest is computed separately and considered as an income. Interest is computed separately and considered as an income. Interest is computed separately and considered as an income. Then number two, the sales method. Number two, the sales method. The sales method, right? This the sales method. The sales method, then you write. Under this method, sales are recognized. Under this method, sales are recognized at higher purchase price. Under this method, sales are recognized at higher purchase price. Under this method, sales are recognized at higher purchase price. Full stop. Under this method, sales are recognized at higher purchase price. Full stop. Then you write and say, the gross profit is equals to, higher purchase price minus cost of sales. The gross profit is equals to higher purchase price minus cost of sales. The gross profit is equals to higher purchase price minus the cost of sales. The gross profit is equals to higher purchase price minus the cost of sales. The gross profit is equals to higher purchase price minus the cost of sales. Then you finalize that statement by having to say another final statement. You say the interest is not recognized. The interest is not recognized as separate income. The interest is not recognized as a separate income. The interest is not recognized as a separate income. As a separate income. As a separate income. As a separate income. So I think we can end there. So we'll pick up from there tomorrow. So you can write a small heading where you'll be able to start, and we look at an illustration. You can do write accounts prepared under the sales method. Accounts prepared. Accounts prepared under the sales method. Accounts prepared under the sales method. Accounts prepared under the sales method. So you can write that heading. Then that's where you'll be able to start from tomorrow. That's where you'll be able to start from tomorrow. So I think we can end there for now, unless there's a question if you can ask. But let me end there for now. Let me end there for today. So we'll pick up from there tomorrow. Any question you might be having, you can ask that. You might be having, you can ask before say hooray. We say hooray for today's class. We say hooray for today's class. That is hooray for today's class. So hopefully tomorrow maybe we might finish topic number 2. So let's see what will happen. Might finish topic number 2. Finish topic number 2. So a higher purchase doesn't have a specific standard. So it is just taken as as a special transaction. It is just taken as a special transaction. It's just taken as a special transaction. Just taken as a special transaction. As a special transaction. Someone is saying, may the grace. So at least the God has been able to take us through the entire class. Now we are through. You can now be able to go to do what? To sleep. The grace of the Lord has actually been with us this entire class. So it is an amen to that. It is an amen to that. Amen to that. Amen to that. So you can have a good night. So see you tomorrow. We'll introduce a revision class. We'll introduce a revision class. Probably it will be happening Saturday. It will be happening Saturday 1 p.m. to 1:45 p.m. So be ready for that class. Maybe I'll be able to start this Saturday or I'll start the other Saturday. And it will happen the entire semester. So you must be able to brace yourself and prepare yourself. There will be a revision class for a FAR. What you've already been able to cover, we'll be revising every Saturday, 1 p.m. to 1:45. So it will be happening for 45 minutes. So brace yourself for that class, which then will actually be recorded and be put on the LMS. So that's what will happen. So have a good night. See you tomorrow.